Oh, hi. Can you all hear me? Give me a hi in chat so I know you can hear me properly. Excellent. And I'd like to thank Sanjeet for organizing this. Thank you so much. I'd also like to thank Plum for making this possible, making me stay back in office at 7:30 in the evening for making this possible. So thank you, Sanjeet. Also, thanks to everyone over here. As you can see, I'm talking to you here, but I can see your chats here. So I'll keep switching over here. So don't mind that. And I can see a lot of people over here and love it. I can see a lot of people in Bangalore. I can see Akash, Rhythm from Ahmedabad. Excellent, right? I think the first thing we need to do over here is understand what level are you at with investing and how many of you have started. So let's do a quick round. Can everyone tell me if you're a beginner, if you've never invested, say I've never invested. And if you have done some investing, maybe you bought a mutual fund or maybe you bought one stock, give me some experience. So if you've never tried anything, say, I'm a first timer, never invested. And if you've done some, say some. So I'll know basically what, okay, now some experience, never experience, excellent. Excellent, super, never invested. So I think I see a lot of people never invested. Here's what's gonna happen, guys. We're gonna talk about what mutual funds are. I'm gonna try to explain two types of mutual funds very easily. So we won't go too deep, otherwise it'll become a rabbit hole. And then I'll tell you what you can execute on Monday. Does that sound good? So when you want to start your investing journey, you can actually start executing right away. Does that sound good? Give me yes. Give me yes if you understood that. That makes sense. But here's the deal, right? Like everything in life, this is not going to be free. You're going to have to put some effort. And I'm going to ask you quizzes every 5-10 minutes. And I need you to participate on chat. If you do that, you will benefit. If you don't, then you've just wasted your time. So can we all agree that you'll spend some time with me today? Switch off your phones, shut that phone off, and even take your, I hope you are wearing headphones in your own room. Shut yourself off for 30 minutes. If you've understood the first 30 minutes, everything will make sense. Yes, give me a yes. Okay, I see I Shapat. I see bring it on. Super, so you're gonna begin. We're going to start slow, talking about what mutual funds are and move forward from there. One last thing. Have you guys heard of me? Any of you have seen any of my videos or went to LearnApp before? Just give me an idea of that and be like, yes, I know you, or yes, I know LearnApp. So I'll get to know if you already know. I see some no, I see big fan, heard by our friends, and I see lots of no's. Lots of no's. It's not great. So let me share my screen. Yes, I've already subscribed. So the host needs to enable screen sharing. So Sanjeet, can you help me? Give me allowance to share my screen, please. Honestly, okay, now we know.
Yeah, Prateek, you can share.
All right, excellent. So now you can see my screen. Can everyone see my screen? Give me yes. Fantastic. I'll also open chat so I can make sure I can see what you're saying. Great. So this is a special that we've done with Plum. We don't normally do this, but Plum was very nice to invite us. So now we are. I would urge you guys to please visit learnapp.com. It is a financial education platform like none other. People who manage billions of dollars teach you over there, and it has great, fantastic quality. I'm sure you love it. We have some amazing people teaching there. So please go to learnapp.com. At least have a look at what it is. And we also run daily workshops running every single day where you can learn from people. So check that out. I won't talk a lot about learnapp.com, but check that out when you can. Now, let's start with something interesting. We're going to start with basics of investing. Now, before you start investing, guys, what you need to do is have an emergency fund. Let me tell you a little story. I was born in Abu Dhabi and I moved to Africa, Singapore, Malaysia, and then I came to India in 2007 and started to trade. You know the biggest mistake I made? It's been what, 2007 minus 2021. How many years is that? The biggest mistake I made was I never learned what personal finance is before getting into trading and investing. I always invested 100% of everything I had on trading and investing. And if I had actually done what I'm going to tell you now, things would have been different. All okay? Okay, excellent. So let me tell you about the first thing you should do, and that's having an emergency fund. I want everyone to open Notepad. You can do it on your phone. You can do it on an actual notepad. Write down your monthly expense. So let's suppose your monthly expense is 50,000 rupees. Take 50,000, multiply it by 6 months, ideally a year. This is the expense you need. So 6 months of expenses 12 months of expenses, stash that in a fixed deposit or somewhere that you will not touch. And that's your emergency fund. Can everyone promise me that they've understood this and they'll do this? The money that you've been left over after that, you can start to invest with. Sounds good? Give me a yes. Have you understood that? Sounds good? So make sure you have an emergency fund. If you don't have one, then you can always aspire to create that. Can I share the full screen PPT, Abhishek? Then I won't be able to show the tabs here. So I hope that's fine. I have said 3 months emergency fund. I think 3 months is really low, guys. Keep it 6 or 12 or somewhere between that. Sounds good? Yeah, excellent. A quick question over here. I've already asked you, how many of you invest in a mutual fund and how many of you are already investing in mutual funds in this time? Give me a yes if you're already investing in mutual funds. Now, the problem is, how do you actually choose or select a mutual fund? That's the problem, right? Mutual fund Sahi Hain. Well, okay. So what we're going to learn today is the very basics of what a mutual fund is, why you should invest, what kind of mutual funds, a checklist that you can use, and I'll also teach a nifty strategy that you can start using next week onwards. Expense ratio, one time, very nice, keep it coming. Here's the very basics, right? Basically, what is a mutual fund? A mutual fund gathers money from investors like you. So people like us, retail people, invest money in a mutual fund. The mutual funds are called asset management companies or AMCs. The AMCs have assets under management. So all the money that they collect or is invested by people is part of a fund. And that fund has an AUM, or the total amount that fund is managing, right? Now, to manage this money, the first thing that they do is, from the pool account, they convert that into small little shares. So it's called units or NAV, which basically is an easy way to sort of buy shares inside a mutual fund. Because if you think about it, a mutual fund has all this money, people are investing, some people are exiting, the fund balance is also changing. And then from that, you also have the investment manager investing that money, exiting that money sometimes. So there's movement happening from 3 sides. People are entering, people are exiting. The mutual fund manager then has the money, the investment manager, the fund manager, he's investing that money and sometimes rebalancing it. So there's a lot happening here, right? So how does the mutual fund know how much to invest and how much profit or loss you made? So for that attribution, that entire fund is divided into NAVs. So far, so clear. Give me a 10 on 10 if everyone understood this, right? Super simple. Pool of money divided into small shares called NAVs. Is this all clear? Give me yes. NAV is the net asset value. It's like a share in the mutual fund. Got it? 10 on 10. Super simple, right? I think super simple. So let's move forward. A bunch of other things that you should know. The first thing is called the total expense ratio, the TER. Now, the mutual fund guy is not going to do this for free. So the way he charges a percentage of the total amount invested, and that is deducted every year. You guys have learned compounding, right? So if you have a certain amount being deducted every year, do you think that is in favor of your compounding or against your compounding? Who can give me, what do you think? If you have a certain amount being charged, whether the markets are up or down, whether you made a profit or a loss, the mutual fund is charging that. Is it against compounding your money or for compounding your money? It's actually against. So obviously, the lower the fees, the better. Of course, you also need to see if a fund manager is really good, then a higher fees may be justified. But generally, a lower fees is better. Now, there's a certain kind of mutual fund that charges a lower fees. I'm sure you already know it, but I'll tell you that in just a bit. There's something called an exit load. So, certain mutual funds have timelines of when you can exit. For example, a liquid fund now has that penalty. So if you exit it after a certain period of time, they charge you more money. So I'll talk about that in just a bit. How do you see if the fund manager is good? Something like for mutual funds. I'll explain that in a bit, Ishan, not to worry. It's not necessary that lower fees implies a good fund. Absolutely correct. I'm saying lower fees is a good thing, but it doesn't mean the fund is good. You also have to see whether the fund is good. These are two mutually exclusive different things. For the TER ratio, I'm saying you should just check how much fees is charged. That's it. Make sense? All right. Give me a okay, everyone, if you've understood so far. Now, there are two types of funds. There is a regular fund and a direct fund. This is where the magic happens. A regular fund is when you go via someone. So if I go to ICICI Bank, okay, I go to ICICI Bank and I buy ICICI mutual fund. Am I going direct? What do you guys think? If I go to ICICI Bank and I buy an ICICI mutual fund, am I going direct? It's actually not. You've not gone direct. Although they're both ICICI, but you've gone via a bank. And this is not true for ICICI, it's true for everyone. You're going via an intermediary. Therefore, it's not a direct fund. You're subscribing to a regular fund. Now, regular funds basically pay commission to the people you're going via. So if you go through, say, if you go through your uncle who is a mutual fund distributor, he's charging a fee. And the reason they do that is because they're advising you on what fund is good, what fund makes sense or not, and therefore they charge for that advice, right? So you have two types. You have a regular fund and you have a direct fund. Which do you think is going to be cheaper? The one with an intermediary or the one without an intermediary? Can everyone give me an idea? Which is going to be cheaper in terms of expense, direct or regular? Without, right? So direct. Can everyone type direct so they've understood? No worries, Akash. Anshul has written something really big. Which one is to choose, direct or regular? I know the pros and cons, but stuck in a dilemma, significant larger wealth possibility with direct. I've chosen out my funds to invest. Request you to consider. Yeah, sure, Anshul, we'll explain all of that. Everyone's understood direct makes sense. Okay, so that's the first thing you should know, direct. The other thing about choosing a fund is you have something called a growth fund and you have something called a dividend fund. Okay. Does anyone know what this means? Which one sounds better, growth or dividend? So I'll tell you, growth is supposed to be growth and dividend is supposed to pay you out dividends, giving you regular income. Which one do you think sounds better, growth or dividend? A mix. No, choose one. Yeah, I can see growth. I can see people typing growth. Dividend is king of stable. Okay. So I'll tell you the difference. A growth fund basically reinvests everything. So if there are dividends paid, the growth will reinvest it, etc. For a dividend fund, the dividend, they'll actually take out money from your corpus and just pay you out. So the compounding in dividend actually doesn't happen. The compounding happens in growth. So I know everyone over here is young. Can everyone just type, I will choose growth. Just that's it. Just type, I choose growth option. Please always choose growth. Because the difference between growth and dividend can be massive. It can be 60% returns versus 20%. It can be that different. So a growth type of fund, direct type of fund is the kind of fund you're looking for. Got it? I'll choose growth. Everyone got it. All right, fantastic. Is my pace okay, guys? Can you just give me a 10 on 10 if so far I'm doing well and I'll move forward? In short, growth fund is best. Yes, Rohit, that's correct. Okay, fantastic. The other thing is alpha. The industry loves this word. One thing, because it sounds cool, because it says alpha. But alpha basically means how much percentage more are you getting from a benchmark or the best case or a good case scenario. A good case scenario is basically Nifty. You guys have heard of Nifty and Sensex, right? Have you guys heard of Nifty and Sensex? Yes. So what is Nifty? Nifty is the average of the top 50 stocks in the country. Sensex is the average of the top 30 stocks. Well, actually, the top weighted average, but it's fine. It's an average of the top 30, top 50. Now, when you invest in a fund managed by a manager, the fund should ideally beat the index, right? Or the Nifty or the Sensex. So if Nifty gave 10%, your fund should ideally give 11%. And that's a 1% alpha. Did you guys get it? The difference between Nifty, which is the benchmark, versus your fund, if your fund beats the benchmark, that's your extra push that you got. That's your alpha. Do you all get it? Alpha samajh mein aa gaya na? Perfect. excess return over benchmarks. Now, here's what you need to do. Equity brings you growth. And let me show you what I mean by that. This is Nifty. Today, someone joined, very recently, someone joined our company. His name is Vasant. And he was telling me something about, there's this company called Philip Morris. Vasant, what is the percentage on that? 4 million, right? So Philip Morris has given a 4 million% return over what period? 40 years. Over like 40 years. I understand 40 years, bahut time hota. It's a very long time. But there is no asset class that can give you a 4 million% return. You cannot make that return. Okay, I'm not saying you can make that return, but it actually happened with a company called Philip Morris. You should also check out the products that they sell. सेहत के लिए हानिकारक हो सकता है, but they actually gave a great return over a 40-year period. So equity is the only asset class which has proven high returns over a long period of time. Can you type this? Equity is equal to high returns over a long period of time. What do I mean by long? I mean 7 to 10 years. Okay. Can you make money in 1 to 2 years? Sure. But your probability of earning in 7 to 10 years is way higher. I think there's a stat on this as well. Let me read your chat and see if I'm missing something. Philip Morris sued Australian government. Yes. Has everyone understood what I said? Yeah. Please type this. Equity is equal to returns in the long term. But what about the short term, right? How do I earn in the short term? In the short term, you want to invest in something called debt. Now, what's a debt fund? A debt fund is when you invest in, I'll give you a simpler example, okay? I give Tata Motors money. Tata Motors uses that money as a loan. Prateek Singh ne mujhe loan diya 100 rupees ka. They use that 100 rupees to actually expand their business, make a profit, and return that money to the investor. Now, how are loans generally paid out? They're paid out in EMIs, right? So a debt fund doesn't really pay an EMI, they pay an interest. So every 6 months or every 1 year, they're even quarterly coupon payments, they pay an interest. Now, this is called your return on debt. Okay, it's just return on debt. They pay that money back to you because you're basically loaning this money to a company. Now, do you generally think, should you loan money to one single company? It obviously doesn't make sense. You loan it to a bunch of companies. So therefore, mutual funds also have something called a debt mutual fund. The debt mutual fund will have a list of maybe 50, 100 companies. And when you invest in a debt mutual fund, they equally sort of, or weightage actually, divide all that money to these companies. It's a loan for these companies and they pay an interest. Now, isme growth nahi hota. You won't get growth here, but you'll get some sort of regular, sort of predictable income. People who've been in the market know that even sometimes that doesn't work, but generally it's assumed high grade debt will give you the return that was expected. Is everyone clear? Is everyone clear on this? Everyone clear on equity? Everyone clear on debt mutual funds? Debt mutual funds, you basically invest and they pay you back a certain amount. Everyone got it? Okay. What should you choose? Equity or debt? Who can give me an idea on this? Equity or debt? Also, guys, if you ask a question, please write 2 lines. Like Gitanjali written, please explain once. What do I explain? I explain 10 things, so I don't know what to explain. Equity if young, all right. Okay, combination of both. I really like that answer, combination of both. Now, in the one trick question, are you ready? Here's a trick question, okay? All right. In a debt mutual fund, we didn't invest in one company, we invested in a bunch of companies because we don't know what company will become Nirav Modi. We don't want to invest in a bad company, right? So what about mutual funds or equity? Should you invest in one single company or should you invest in something else? Can you give me an idea? What should our strategy be for equity? Multiple SIPs, diversified, multiple companies. Okay, multiple companies, that's right. The correct answer is, and this is a very long argument, I could have spent 30 minutes explaining, but I'll give you the answer. If you're new, you invest in Nifty. Okay, it's called index investing. You invest in the market because that is the market. most funds are not able to beat the market. Why? Because they will choose the same list, change the weightage, and sometimes they will do better, sometimes they will not do better. And an index will always do better, actually always be the same, because that is the benchmark. So can everyone type, if I'm a beginner, I'll select an index fund. Can you just write that? I will select an index fund. Absolutely right, Rhythm Patel. I love your name, Rhythm Patel. That's a really nice name. So that is what an index fund is. An index fund invests in Nifty 50. It can also be other indices. It could be a pharma index. It could be other index. But like Nifty 50 is what you're going for. Got it? Okay. Can everyone give me a 10 on 10? We've understood debt. Okay, it's a collection of this thing. We haven't talked about the types of debt. Equity, we talked about, okay, different types of mutual funds. Cut the crap. If I'm new, index fund is what I'll invest in. Got it. Here's the great thing. Index funds are replicating the index, right? So is there a need for a manager in an index fund? Who can tell me this? Is there a need for a manager in an index fund? If I give you a list of stocks to invest in and you have to invest it, like, is there a need for a manager? Give me a guess also. See, Josh has said guess no. Give me a no. No. So will the expense ratio be lower in an index fund? Yes or no? Yes, it will be lower, right? Of course it will be lower because there is no one managing it. So it's sort of helping your compounding over here. Did this help you so far? Like, I hope it's clear. Index fund karna hai. If you don't have time, index fund karna hai. Simple. Yes, yes, yes. Okay, let's move forward. I'd also like to say I'm a fully algorithmic trader where I place multiple trades every single day for the last many years. And I'm talking about investing. So there is a better way to grow wealth where you can spend maybe 5 minutes a week and actually grow your money. You can actually, if you have time, you can actually learn strategies, right? Like we have something called growth investing. We have a course by Anando, which just teaches that, but it requires time. If you don't have time, don't do it, right? If you can spend 5 minutes a week and you can do that yourself, you don't even need a mutual fund. The growth investing strategy, you can actually apply once a week, once a month, and actually do a better job yourself. There's also Atul Suri, that's also. So if you have time, explore investing strategies because you've just optimized your life for the better, correct? But if you don't have time, please don't do that learning. Just look for an index fund. Is everyone clear on that? If you don't have time, use the index fund. If you have time, explore an investing strategy. Even that takes about 5 minutes a week or so. All good? Now I'll just see if there are any questions over here. All right. Yeah, we'll go through these questions. Perfect. All right. Okay, let me see where we are on the channel here. Okay, I won't cover all this. Yeah, here's another thing, right? When you're selecting mutual funds, you'll see a bunch of mutual funds giving great returns. But markets move in cycles. So sometimes small caps is doing well, sometimes FMCG is doing well, sometimes large cap is doing well. So if you are a mutual fund manager or owner, you're the CEO of a mutual fund, what will you do? You'll push the funds which like did well. Actually, mutual funds don't even do that. Aggregators do that. So when you go to any news site or anywhere else, they'll just show you the best funds that did well last quarter or last year. But so that's not a good way of investing. Did you get it? Because everything is moving in a cycle. Kabhi FMCG chalta hai, kabhi kuch aur chalta hai. Sometimes certain sectors do well. It's easy because funds have all kinds of funds. It's easy for an aggregator to just pick the funds that did well and show them as the most profitable. And we assume, oh, this earned 30% last year. It will earn 30% next year. It will not. So you need some skill to identify which sectors are moving, and you can actually do that. You can actually move from one sector to another in mutual funds and actually earn far over Nifty. But you'll have to, I hate to shamelessly say this, but you'll have to take courses on LearnApp to learn how to do that. And that takes time. So my point is, don't try to pick funds based on returns. Just pick an index fund and I'll tell you what checklist to follow to pick that index fund. Is everyone clear? Please type clear right now and I'll move forward to a super cool strategy you can use. Okay. All right, I'll move forward now. I'm sorry. Okay. These are the two kind of funds, right? You have index funds, Nifty 50. For the more aggressive type, you can try Nifty Next 50. I won't explain what Nifty Next 50 is. Please Google it. It's basically the first 50 stocks, top 50 stocks in India, Nifty 50. The next 50 stocks, that is number 51 to 100, is the next 50. So these are slightly smaller and they move a lot faster. So if the economy is hot, these guys move more than these guys. So the Nifty Next 50 is also a good index. And then there are mid-cap mutual funds, etc., which I will dissuade you from today. I want to show you something cooler. Could you explain the difference between Nifty Next 50 and Nifty 100? I just told you rhythm, you got it. The first top 50 is Nifty 50. The next top 50, so that means the 51st largest company in India to the 100th largest company in India is the Nifty Next 50. Got it? Okay, so there are two kinds of funds you can invest, guys. One is a liquid fund. So now we're done with equity. Okay, you know what? Can I change this a little bit? Okay, I just got a better idea. We just talked about equity. I want to talk about cycles. Can we do that? We talked about cycles. Let's understand, can we capture the cycle? Are you interested to know that? Can I do that if you guys are ready? Yes? यार ये cycle को कैसे समझे? थोड़ा ये समझे? Okay. I hope you don't get confused. I'm going to try. So please type positive things, then I'll keep going. This is Nifty. Okay. The great thing about markets is whenever you look at the markets, they'll always be going up. The moment you enter, it starts falling. And this is a universal truth. You can do this in Japan. You can do this in America. Can someone tell me why? कि मैं साला enter किया market वहीं गिर गया. Why, right? The answer is because all of us are so normal and equal to each other. None of us are original thinkers. All of us are monkey see, monkey do, which means किसी ने छीका, मुझे भी छीक आ गई. Someone laughed, I'm also laughing. The market's going up, I'm also buying. Right? Basically, our instincts is exactly the same, right? And all of us tend to enter when markets are rising. And then when markets fall, all of us tend to go into depression and say, "Nahi, beta, I can't buy the top. I can't buy the trip, or tell our wives we can't go to Goa because paisa chala gaya." So I'll tell you what you can do to actually save yourself. So this chart, what I'll do is I'll change this to a weekly chart. Don't worry about what the red and green bars are doing. Just worry about the direction. How is the market going up? How is it going down? And I want you to observe something with me. So, okay, now I've got to zoom out. All right. So this is, in fact, I'll open the monthly chart for Nifty. I'm realizing I should be sitting and explaining this. I just realized I'm going to stand for 1 hour and explain cycles to people I will probably never meet in my life. Okay. This is the chart from 1991 all the way to 2021. Holy shit. If you see this, you will see three things. Okay. You will see over here, the market wasn't moving. You will see here, the market went up. And then here, the market fell down, went up again, went sideways, went up again, came down, and then a huge climb in 2021. To be honest, all of you care about the markets because the markets have gone up. If they had just gone down, you guys would not be attending this session today. And you'd probably be attending a session on maybe sexual health because there's no down market in sexual health. But in the market, people get interested only when the markets are up. So the question is, how do we know when the markets may move downwards or go up? Do you want to answer that question? Give me a yes. Give me a yes. You want to answer that question? I'll give you a simple way to do it. So guys, I'm going to simplify this for you, okay? We won't go too deep into why and how it's being calculated because it'll take too much time. But I'll give you a reference point. Okay. Do you guys have that television at home where you increase the volume and it starts with green, then it goes to yellow, and then it goes to red? What does that mean? At red, it means the volume is too high. Don't be stupid, reduce the volume, right? You guys seen those TVs, right? With that going from green to loudness, right? So what if there was a sort of an indicator for the prices of the markets, that it's too red right now, which means it's too hot right now, it's too overbought right now, and green meaning, dude, it's too underpriced right now. So this means you have to stop looking at news, you have to stop looking at everything and just look at what I'm telling you. Okay, this is going to change your life if you are able to follow it. Most of you will get up tomorrow and completely forget. Please don't do that. Look at my screen very carefully. You will see this chart of Nifty. I just want you to look at two things on this chart. Let the page refresh. For some reason, it is refreshing. Wait, let me refresh the page. So while the page refreshes, there is a chart of Nifty on it. Ignore that. Only look at, I'll tell you what color it was. Okay, here it is. Okay, you see the blue line. Just look at the blue line. Every time the blue line went near orange, the market was overbought and the market crashed. Every time the market came near light green, it went up. So let's look at this. And this is a pricing level. It's called a price to equity ratio. Don't worry about what it is. It tells you how expensive or how cheap the market is, just like that remote control. So you'll see here, at this point, the market was super cheap because it's in a green zone. Then it came to an orange zone, then it came to a green zone, then it came to an orange zone, then it came to green zone, sorry, yellow zone. Then now we've hit new highs and we're at this extreme red zone from which it's come down. Now, this range will decide तुम में कितना जिगर है और how much expensive or cheap the market is. This over here is extremely expensive. This is sort of fairly valued in this area, right? So between 20 and 27, we're sort of okay-ish. Below that, we're underpriced. Now, when will the market hit this? No one knows, right? No one knows. In fact, myself, when the market was here, I thought we will come here and I'll double down investment. That didn't happen. The market just rebounded. So what you have to think is, when the market is in the red zone, you should not invest at that time. Okay. The general consensus is you should keep sipping. Not that, but you should keep entering the markets every month with a sip. Please don't do that, because if you're attending this workshop, you want to take control of your financial destiny. Don't buy equity when you're in the red zone. Okay. And this will be very painful because sometimes the market will keep going up. Once you're in the orange zone, make sure you're investing. So this could be a smaller amount. If it comes down to this or green, which is where we are, you can invest a little more. Keep investing every month. If it comes down to green and you're very lucky, but the news is going to be terrible. Everyone's going to say this is over, the world is khatam, tomorrow the market will not exist, ye to ab to sab khatam ho jayega. It will be negative news. Some people may even lose jobs because the economy won't be good. But that's the time when we're here, when markets are super cheap, that they actually double and triple in price over a short period of time. So if you have to use कि market expensive lag raha hai ki cheap, this is a great way to understand that. Has everyone understood? Give me a yes, and then I'll take questions after this. See, why is P ratio calculated? It'll take me like 20 minutes to explain. So it'll take time. So I would avoid it. All right. Did you like this strategy? Now I have a question for everyone. Imagine the market goes to 100. A person, okay, where do I find this thing? Just type Nifty PE ratio and you can find this data on Nifty PE ratio. Very simple. Okay. Now imagine the market becomes fairly valued, you invest, and then it's going up, you make a profit, I guess, paper profit. It becomes too expensive, you stop investing, and then it comes down again you invest, and then it goes up. So what you're doing is you're optimizing to buy when the market is fairly valued. Remember, not cheap, fairly valued, matlab near the median. And you're not buying when the market is really high, which means that dip, you will not see itna bada loss. So your returns will actually, hopefully, be better than what you see in normal Nifty, because you're not investing at the top, you're investing somewhere in the middle. Does that make sense? Law of averages, right? Prem says not a topper in class. Basically, guys, look at the blue line. If the blue line is near this area, that's this orange and greenish area, it's a fair time to invest. At this area, it's a really good time to invest. Just keep your horizons long because this is really good. When it's above this orange and red area, just stop investing in equity. It's a good idea to just stop. I have. Right now we're here, so you can invest a little bit. Don't ignore the red line. The red line is the Nifty line. Just ignore that. So did you sort of get it? Give me a 10 on 10 if you sort of got it. If the blue line is near this area, you're investing. In this area, you're not. In this area, you're like, holy shit, I've got to invest in equity. Is everyone clear? Give me a 10 on 10 if you've got it. Excellent. So now Prem says this also applies to stop investing in mutual funds if the graph is in red. Yes, that's correct. Did you enjoy this? This is a pretty simple strategy you can use. It'll take 5 minutes of your time and do this. So this is what an investing strategy looks like. And I've given you maybe 2 out of 10 things that you can actually do to make it a lot better. There are ways to actually exit before the fall happens, way to optimize for entries, etc. That's what an investing strategy is. So if you're interested to put in that one-time effort and learn a skill to like optimize equity over your lifetime, please consider taking courses around equity investing. There are a bunch that we also have. I'm sure you'll find stuff on the web as well. But if you've reached this far and you've not dropped off, then maybe you might find this interesting. Now, what the current question is, when you're not investing in equity, what do you do with that cash? Can someone tell me? When you're not investing in equity, what do you do with that cash, man? Any ideas? Any thoughts? Gold, I would not say no. Yeah, I would say savings account is also fine, Benny, I guess. Sitting in my bank, okay, that's a good option. You can also consider debt because debt will actually give you some returns, right? 5 to 8%, depending on what the market is doing. Right now, I think liquid funds is almost no money and FDs are actually giving better returns than liquid funds. But in most cases, liquid funds actually give better returns than FD. But in times right now, fixed deposit is actually better than liquid funds. But please consider seeing FD, seeing this, all of that. This is also a skill. By learning cycles, you can know in the next 6 months which debt instrument will give better returns based on where the money flow is. But again, you'll have to learn that skill. Simply choose between a liquid fund or maybe a fixed deposit until the market becomes a little more affordable and you start putting money in equity, right? What I'm trying to do, guys, I'm trying that you don't invest when the market is too expensive, right? That's something we can definitely avoid. Because if you're spending time here, you care about your money, right? You care about your future. And if you're spending that much time, at least don't invest when the market is expensive. And there are, of course, ways to make money as the market falls. But again, you need to spend time on that. Could you have a quick explanation to bonds in case to invest that cash in hand? Sure. Should I explain bonds? Is anyone interested to understand debts and bonds? Does that sound good? I like how Komadur says no, not interested. I wish I had a teacher like you in school. Thank you, Prem. You made my day. Yeah. Okay. So I'll just quickly explain bonds for you. I am looking at money control, but you can look at basically any site. There are a few ways to do. Okay, wait, sorry. There are 2 types of here, right? So historical returns. Okay, here. So for example, these are index funds. For equity, you can choose index funds. Where's the, okay. There's something called ultra short duration funds. These kind of funds is something that you can look at. You can sort by AUM and find growth plans within these short-term funds. And these give you rough returns on this, right? So as you can see, the bond market isn't too great right now. The last 1 year has given 2-3%. But so choose between liquid, FT, and short-term or medium-term bonds. Won't it work for stock analysis? Yeah, so there is a way to actually do this analysis for individual stocks. And instead of investing in the index, you can invest in a bunch of stocks and optimize for the cycle, Mona. But again, you need to learn an investing strategy to learn how to do that. Does that make sense? Cool. I'm just seeing now what else we have over here. No problem, Mona. I have a checklist over here that I wanted to show you. And that's this, right? So generally, when you're between 20 to 35, you invest majority of the money into equity. If you are between 35 and 50, hybrid funds or like some debt, some equity is a good idea. If you're 50 plus, like it's all debt, right? Because you may not have a lot of time on your hands. But generally, generally, if you're able to follow the cycle, then you can put 100% equity, market cheaper ho jata hai, more equity, expensive ho jata hai, back to debt. That's a good way to enter and exit the market as well. Dark. Ramya says dark. But in Corona times, you don't need to be 50 to have less time on your hands. Let me see if I have a checklist over here. Before we do that, can you do me a favor and maybe tag Plum and LearnApp on Twitter and say that you enjoyed this workshop? If you did, it'll really, really be nice that, you know, I could spend, how long did I spend with you? 45 minutes, right? 45 minutes, right? 7:30 to 8:30. So if you can do a quick, this thing that you enjoyed this and you learned something, it'll just make our day because we put a lot of effort in finding this out and explaining it in a nice way. So I'll be really, really happy if you can do that. Also, if you can visit learnapp.com and check out if something's for you, we'll really, really appreciate that as well. We're such a small team and we're just trying to change the country by helping people just understand money better. I think the people of our age are very different from our parents, right? Our parents said, hire a CA beta, or get an advisor, he will tell you where to invest the money. But I think our generation wants to understand how cycles work, how portfolio management works, and just spend that 5 minutes a week and just manage our own cash. So if you're like that, you know, and we said we should build a platform which teaches this to people, and I hope you're doing a good job. So check it out. Encourage us if you're not joining. So, you know, our motivations are high. And I'll quickly get your questions over here. So please put in your questions. I'll take 4 or 5 questions and try to help you out. Okay, mutual funds versus small cases. I think that's great. Both are baskets, but I think both are baskets, right? Essentially. But the question is, which basket do you invest in? So that way index is better if you don't have time and the way that I told you. But if you have time to understand, okay, these cycles work in this way and I can follow this trading investing strategy, then you can create your own baskets and just manage them. And that's one way to do it. Can you spend some time for SIP? So SIP is basically a systematic investment plan. It's a fancy way of saying reverse EMI. That instead you will pay a certain amount every month into your into certain funds. But like I told you, certain times you can actually stop that SIP because markets are too expensive. The online platforms you would recommend for investing. So I think all brokers you can use for ETFs. There are a lot of aggregators out there. I think there's Coin, which you can try out, which is direct mutual funds. So try either Coin out. Reading graph of Nifty was good. Is that something that can be utilized for all graphs? Yes, Kapil. So when you actually learn an investment strategy, you can actually do this. And that's what you'll be doing every 5 minutes a day to understand where the cycle is and where I should move my money. And okay, now I should move into FMCG. Now I should move into pharma. Right now, we're just saying expensive exit kar lo. It's very simple. But you can actually optimize it more by going into different cycles and stuff. So yeah, you can do that. Sovereign gold bond is better or direct purchase? Of course, a sovereign gold bond is better. There's no competition. A quick thing over here: digital gold has a 5% commission. I just thought you should know. If you purchase digital gold online, it has 5% commission. So sovereign gold bond, I think that makes sense. Just bumping this up again. Understood all the nuances you told. They were awesome. Thank you so much. Just to make sure I'm not making a blunder. This looks like a big question, guys. Query is, which one to choose, direct or regular? Choose direct. I know the pros and cons, but stuck in a dilemma. No, you choose direct. There's no doubt about it. There's no dilemma. You choose direct. I have chosen out my funds and invest in stuck the way of confusion. Choose direct. That's it. Very simple. Don't choose. Why would you choose regular, dude? Unless that guy is coming home and serving you chai and helping you out, then it's fine because the advisor will help you out. So if you need advice and you need an advisor, then choose regular. But if you're making your own decisions, choose direct. Just make your decision today, okay? Don't procrastinate. Okay, I see lots of questions. Markets are highly volatile, says Prem, but I've started investing mutual funds. As per graph, it's not suggestible to invest right now. Should we exit and come back, right? Mutual funds later. I'll say this again. Right now, you can invest, but a little bit. Don't go all out. There are ways to invest in this market, but you have to learn an investing strategy for that, Prem. So if you're interested, you should learn that, or just wait for markets to cool off, depending on how much. If you have time, then you should learn an investing strategy. Any opinion about GrowApp? It's fine, good. One last question. Can you recommend 5 mutual funds beating the index? Rishi, I told you not to do this shit. What do you mean beating mutual funds? You cannot, no one knows which fund will beat the index. Don't attempt to select that. Just don't do that, Rishi, okay? Just select an index fund or learn an investing strategy. That's it, 2 options. What's the max returns that you've achieved with all the optimizations? Benny, I know what you're trying to do is you're trying to find out whether I was able to consistently make more money than the index. I think this is a bad question, but I would say as a trader, which is different from investing, I've seen months where we earned 15, 20, even 30% in a single month. Does that happen every month? Of course not. Returns can be huge returns, then nothing, and then some returns again, then nothing. But overall, if you're involved, you can do a lot better. But I hope I answered that question, but it requires effort and time to learn. But is it worth it? Yes, because you're changing your life, right? You're able to focus on other things because the money part is being optimized. For a beginner, which website would you recommend investing? I don't know what that means, but you've learned it. You can go to direct platforms and purchase it. Cool. I see a lot of questions, guys. Lump sum or SIP. So I think Ramachandran missed it, but SIP while the market is affordable. When it's expensive, don't invest. So guys, if you enjoyed this, please visit learnapp.com once. I hope you liked it. Thanks, Plum, for doing this. Tweet out a little bit if you liked it. It'll be huge encouragement. Can you give me a 10 on 10 if you enjoyed this session? So I have, at least I leave with a smile on my face. Yes, give me 10 on 10. Super. Thank you so much. Why don't you mute me now?